When you have an exit plan, you can more effectively deal with the unexpected because you know your current state, know the path you're going to take, which enables you to navigate change much more easily. Next slide. The exit planner role. This describes the process that we as exit planners use when working with business owners. Keep in mind that exit planners can be CPAs, financial planners, business consultants, and attorneys. The key is to make sure that any and all advisors are working together and in your best interest. Some exit planners determine business readiness as well, and Mark and I do that. This is where we evaluate the business's readiness to be transitioned. We start by asking, do you run your business as if it's for sale? If you did run your business as if it were for sale, what would be different from the way you run it now? It's a really great place to start.
Next slide, please. John Leonetti, who is a leader in the area of exit planning and the author of Exiting Your Business, Protecting Your Wealth, does an excellent job in his book in scoping out what needs to be addressed as part of this process. And it is a process. You need to remember that. It's fluid in how it may be approached, but still a process in that certain steps need to be covered somewhere along the planning journey. Too often people look at exiting a business as simply selling it. It is so much more than that. Change is an event. Transition is a process. Next slide, please. Here we give you a comparison, a distinction between just selling the business and developing an exit strategy. Let's spend some time on this, starting with the selling side. When you sell a business, most advisors only get paid when there is a sale. They aren't concerned if the sale is a good one for the business owner, or at least some of them may not be. They just care that there is a sale so they can get paid. So the goal becomes finding a buyer, any buyer, so the business can be sold. Whatever is currently going on in the market will affect the sale. Hopefully there will be multiple bidders for the business, but don't count on it. With an exit strategy, the focus changes to the owner. The owner's motivations are what rule. This never changes. All items to be considered are measured against how they meet the goals. The transfer option that best meets these goals is the one that will be implemented. It has nothing to do with what the advisors want. Remember, this is a time to be selfish in that it is important for the business owner to get what they want out of the transition. With an exit plan, the advisors are focused on doing what is right for the owner, not themselves. The goal may or may not be the sale of the business. The owner may just want to reduce the risk of owning such a highly valued illiquid investment. There are other ways to reduce this risk besides a complete sale. A private equity recapitalization or a partial sale to an ESOP are options that come to mind. The buyer may be found or created. ESOPs are a great example of a created buyer. Management may be found as a buyer. The buyer does not have to be found outside of the business. With internal transfers, the process is controllable. Issues in the market can be avoided. Time is available to explore all options. All transfers are considered, both external and internal. Next slide, please. These points continue to show the difference between a sale and an exit strategy. A sale is just that, a sale. A proper exit strategy examines all possible transfer options. Price is not the main consideration under an exit plan. One thing to clearly understand is that the highest offer for the business may not result in the most cash to the owner-seller, nor may it meet the owner's goals better than all the other options. Sales are usually taxable, resulting in large taxes and large fees. There are ways to minimize taxes under some transfer options. Using ESOPs and Section 1031 exchanges are two approaches that come to mind. The bottom line is the sale is just that, as I said, a sale. An exit strategy starts with the development of goals and ends with the identification of the transfer option that best meets these goals. Next slide.
So let's take a look at the first step in the exit planning process, which is setting the exit goals. When thinking about your exit goals, we'll talk with you about what is most important to you about this transition. What would you want to be different about your life when the transaction is complete? We want to continue to ask questions such as the ones on the slide and have a discussion around your goals and the key issues that emerge. Next slide.
The next step is financial readiness. Most business owners are comfortable with the concepts of balance sheets and cash flow projections. Well, that is what is the basis for the determination of financial readiness. It's necessary to project what the anticipated annual cash outflows will be for the business owner to live the lifestyle they want to live after they leave their business. The next step is to understand what assets the business owner has, as these will be the source of most of the funding of their lifestyle. The value of the business is typically the largest asset that a business owner has. There are a range of values to a business depending on whom the buyer is. These values need to be calculated by someone with the necessary experience. Once the valuation is complete and the personal balance sheet is done, a projection needs to be prepared as to how much annual income can be generated by these assets. This income, plus cash flows from any other income flows, such as Social Security and the like, is matched against the projected outflows. Next slide, please. If the inflows exceed the outflows, the business owner is what we call one of the lucky ones. They basically can do whatever they want to do with the business. That's not what we normally run into. The situation that we normally see is when there is a value gap, that the assets are not sufficient to provide the level of funding that are needed for the lifestyle. Then at that particular point, there are tough choices that need to be made. The business owner in this situation has two options. Neither one of them they're really going to like. The first one is to figure out how to reduce the outflows to match the inflows, or they need to grow the asset base to increase the inflows. That's about it. There's not much else you can do there. So most people are not happy with the idea that they're going to cut back on their lifestyle. So what they normally do is they'll investigate what can be done to increase their asset base. It's our experience that the best way to increase the inflows is to continue to own the business, work to increase its value, and increase other investments while still owning the business. Next slide, please.
So the next step in the exit planning process is mental readiness. And for many business owners, they can't even begin to think about leaving their business because working is all they've ever done. And for those who have nurtured and grown their business, it's very difficult to think about severing ties with it. It's an emotional process. And I'm sure many of you can identify with this. Many people identify who they are with what they do. It's all wrapped up together. And the fact is, we really are so much more than that. The work we do with business owners is to unwrap that and get them to identify the many roles they play in their lives in order to create a stronger identity for themselves. As one role diminishes, it makes room for other roles to flourish. This work that we do together enables the business owner to think more positively and with less anxiety about what the future holds for them. Within the context of mental readiness, it's also important to look at your work as contributing towards your investment, not just a job. This reframe is important because it begins to allow you to emotionally disconnect from your work, and that helps you see the possibilities for your future. Your business proceeds will ultimately provide for your retirement or for your next venture. In order to reduce anxiety and plan for the future, it's important to focus on what's ahead. So a critical piece of mental readiness is to work on what you're moving towards rather than focusing on what you're leaving behind. By creating a vision for the future, you can then see the possibilities of what the future will look like for you. William Bridges, who is a thought leader on change, says that it's not the changes that do you in, it's the transitions. Change is the external event or situation that happens to you. Transition is the psychological process you go through to come to terms with your new situation. So while change is external, transition is internal. To illustrate the importance of mental readiness, I'd like to ask Mark to share a personal story with you.
My father was a small businessman. He lived in the North Shore of Massachusetts, and throughout his life he owned different businesses. The last business that he owned was a corner variety store. He had a partner in that particular business, but it was the type of place that people would stop in frequently, buy their lottery tickets, their beer, their milk, juice, bread, sandwiches, those type of things. And when I used to visit my father, I would always notice that he just loved his interaction with his customers. That is what he got the most enjoyment out of. He knew them. They were all like friends to him. Well, my father and his partner decided that, I think my father was 66 when they sold the business, that they had had enough of it. So the next day after my father sold his business, he basically stayed home. He was at the apartment that he shared with my stepmother, and his life changed into one where his daily routine became a matter of reading the Boston Globe and the Boston Herald from front to back and running errands with my stepmother. When I'd see him, I used to turn around. I almost beg him. I said, "Dad, will you please go get a job? Go to the grocery store. Get a job bagging groceries. You need to be with people. You just can't cut yourself off from people this way." Well, no, my father never did, and within 2 years after retiring, my father had passed away. Whether there was any connection with the cancer he developed or anything along that line, we'll never know, but I can definitely say that his lack of having any mental readiness for what was coming at him was definitely a factor in his life.
Yeah, absolutely. Thank you. Next slide. So whenever change is involved, there can be a level of fear involved for some. Dealing with fear head-on can be transformational and will motivate you to act. It can get you unstuck, and sometimes you need help with that. At the core of the work around mental readiness is what will you do after you leave the business. As we talked about earlier, it's about creating a clear vision of the future rather than focusing on the past. Now, in order to do that, you as a business owner need to have a clear understanding of who you are. The work you've done in your business has provided you with meaning and purpose in your life. After you transition out of your business, you'll need to still find meaning and purpose. This is a fundamental piece of the work that we do. The mental readiness part of exit planning provides that by working to find other roles, other areas in your life where you can find meaning and purpose. And I think Mark's story is a good illustration of the importance of this. Next slide. I like this quote and find it applicable to change in exit planning. We as exit planners start with the end in mind. Next slide.
One of the other areas that we've mentioned that we address is business readiness. And we've said a number of times already that the exit planning incorporates a determination of financial readiness and mental readiness, and these are specifically focused on the owner. The other readiness that needs to be considered is the readiness of the business to be transferred. By this we mean how well is the business operating? Is it functioning at peak efficiency? In our experience, no one runs their business as if it is for sale, even though they should. Owners should be running their businesses if they're for sale as if they're for sale all the time. The reason for this is that better run, more profitable businesses are worth more than businesses that are not run as well and make less money. That's just a fact. Buyers will pay more money for a business that will return more money to them on their investment. Again, it's a fact. Unfortunately, very few business owners run their businesses this way. Instead, they continue to function without goals, with undocumented processes, with employee issues still to be addressed, and on and on. A business readiness review identifies areas that should be improved to increase the value of the business. While the determination of business readiness applies in all situations, it is critically important in those situations with a value gap. This is because the next step in looking at is to look at increasing the assets, and the assets that normally is going to get looked at is the business. So we need to turn around and handle that from the business readiness standpoint. Next slide, please. I'm hearing hail out there. It's like